The $5 million goes into the trust, and Charlie gets a note for $5 million.
Let's say I own it myself. And I listen, everyone's telling me about the 1031 exchange. Like for me to make this work, I've got to run out and I've got to go identify 3 properties and in a rising market, so along comes Brett Swarts and he starts telling me about this thing called a DST. And I like what I hear. So how do I go about doing this? Because the thing is, with a 1031 exchange, what we're looking to do is, I tell all my students and clients, you got to find a QI, you got to find a qualified intermediary. The laws on 1031 exchanges are too esoteric. I don't know them. You got to go talk to a QI to see what you need to do. What do you advise somebody in my situation to do?
You understand the law and the structure, and you bring in your trusted advisors to get their approval. Okay, so my role in this, Charlie, is we call it the guide. Okay, and the brain surgeons and they're the CPAs and tax attorney. Another word for guide would be like the nurse. So Charlie, first of all, I take your pulse and I say, okay, what is your tax liability? What are your goals? What are you trying to do? Okay, well, you might be a good fit for the Deferred Sales Trust based upon what you've said. And let's connect you with our brain surgeon. But before you get surgery, bring in your brain surgeon, your CPA, your tax attorney, make sure they have their blessing before moving forward. But practically speaking, understanding the first part of it, which is IRC 453, which is the seller carryback, Charlie. So I want your listeners to understand that this law goes back to 90 years, okay? And they actually probably know seller carryback, and their CPAs definitely do. But let's just walk through a scenario. You're selling a $5 million deal, Charlie. Let's imagine your basis is 0. You've owned it for 30 years. And you're going to pay about 37% of that in tax. Call it 40% with depreciation recapture. So it's a significant tax bill. You definitely need a tax referral strategy. You're committed to doing that. So you have a buyer lined up and he's ready to pay you $5 million, top dollar for your property. You decide not to do a 1031 exchange. And here's why. You say, I want to do an installment sale with the trust to keep it deferred. Taking one step back though, imagine I came to you, Charlie, and said, I'm going to give you a 0 down payment, Charlie. Would you carry a note for $5 million? Just a regular seller carryback. In that scenario, Charlie, if you receive 0 down payment, you're in what's called, you don't owe any tax right now. You're in a deferral state. You carried a note for $5 million. In a traditional deal, you wouldn't do that because I have no skin in the game and I could run your property into the ground. You may have to foreclose, right? The other reason you wouldn't do that either is I'm probably going to pay you back in a couple of years anyways, and you're going to be in the same situation you were before. Well, the Deferred Sales Trust, they're 10-year notes, and you can renew every 10 years for 10 years. But the only difference is what we do is we have the trust jump in right before close of escrow. And it says, Charlie, I'm going to buy your position for $5 million. And that buyer's already lined up over there. As soon as it closes, I'm turning around, I'm selling it to that buyer for $5 million. The $5 million goes into the trust, and Charlie gets a note for $5 million. Now, Charlie, if the trust bought for $5 million and sold for $5 million, how much gain does the trust have?
0.